Hey everyone, and welcome to this explainer. If you're a CMA Intermediate student looking to absolutely nail your exams, you are in the exact right place. We're going to take your textbook material and transform it into a clear, logical, visual study guide on the fundamental concepts of auditing. Our goal today? To make sure these aren't just dry words on a page, but a framework you can effortlessly pull from memory when exam day rolls around.
So let's kick things off with a pretty basic but totally crucial question. If accountants are already doing the math and putting together the financial statements, why on earth do we need an entirely separate profession just to check their work? I mean, financial statements are the end products of a formal accounting system, right? Well, the reality is that merely recording transactions in the books doesn't actually guarantee those statements are reliable enough to support massive, high-stakes corporate decisions.
To figure out why, here is our roadmap for today. We'll be looking at the need for auditing, the evolution of the practice, defining the audit, accounting versus auditing, the objectives of an audit, and finally, the overall significance of auditing.
All right, first up, the need for auditing.
You see, just writing down transactions, that's not going to cut it. We desperately need an independent appraisal of those recorded facts to protect companies against two huge threats. On one hand, you have honest, unintentional human mistakes. People make errors when recording complex facts. It just happens. But on the other hand, you have the darker side, deliberate, organized frauds. Auditing provides that independent appraisal of the data so that management's claims can actually be trusted by the outside world.
Moving right along to number 2, the evolution of auditing.
Now, I think you're going to love this. This isn't just modern corporate red tape. It's actually an ancient practice. Back around 300 BC, Chanakya, the brilliant advisor from the ancient Mauryan Empire, actually identified 40 different types of embezzlement. In his famous book, Arthashastra, he made this amazing observation. He noted that tracking government funds is as tricky as watching fish drink water. You literally just can't tell how much is being consumed beneath the surface.
It's wild to think about, right? Tracking financial truth has always been a major societal priority. Way before modern corporations were even a spark of an idea, the ancient Egyptians, Greeks, and Romans were already conducting audits of their public accounts.
Flash forward a bit on the global timeline, and things started to really formalize in 1494 when Luca Pacioli introduced double-entry bookkeeping. But the real game changer? That was the Industrial Revolution in the 18th century. It created these massive, large-scale businesses which completely diluted the direct control of the proprietor. Suddenly, owners were separated from the day-to-day operations, making independent verification absolutely critical.
Bringing it closer to home with Indian corporate history, it's fascinating to see how the rules tightened over time. Audits started out as strictly optional under the 1857 Joint Stock Companies Act, but then became compulsory in 1913. By 1956, the law stepped it up by requiring highly qualified, independent professionals to do the job. Oh, and a fun fact for you future CMAs, a 1965 amendment officially introduced the concept of cost audit in India, and later in 1984, the Income Tax Act brought in the tax audit. It's been a constant evolution leading right up to the modern 2013 Companies Act revisions we use today.
Okay, on to Section 3, defining the audit.
For the exam, you absolutely have to have the SA 200 definition locked down. It states that an audit is an independent examination of financial information of any entity. Period. Whether it's profit-oriented or not, big or small, it doesn't matter. The ultimate goal here, and you can't forget this part, is not just checking the math. It's expressing an independent opinion on that information.
Then we have the ICIA definition, which honestly takes a much broader view. It recognizes that modern auditing goes way beyond just the financials. Today, it's a systematic examination of operations, compliance, records, and managerial performances. It's really a holistic appraisal of the entire enterprise.
Section 4, Accounting versus Auditing.
This is a classic exam topic, so let's make sure it's crystal clear. Think of it like this. Accounting is what creates the financial narrative. It measures business events, records them, and prepares the financial statements for management. Auditing, however, is the critical, independent review verifying if that narrative is actually true. The auditor isn't creating the statement. They're appraising its authenticity. Basically, auditing steps in right where accounting leaves off.
Number 5, objectives of an audit.
Let's break these down into two buckets to make them super easy to memorize: primary and secondary. The absolute primary objective, which is backed up by Section 143 of the Companies Act 2013, is to determine whether the financial statements present a true and fair view of the company's financial position and performance. That primary objective is the entire reason the auditor is in the room, to provide that crucial stamp of credibility.
Then we have the secondary objectives, which are basically your safety net. While the auditor is focused on that true and fair view, they're also keeping a close eye out for the early detection and prevention of both unintentional errors and deliberate frauds. Catching these things early helps immensely in strengthening the company's internal control systems.
And finally, Section 6, Significance of Auditing.
Why does all of this matter so much to the real world? Well, an audited statement is basically the gold standard of trust. It gives shareholders the total confidence they need to make huge economic decisions. It allows the government to make timely tax assessments. If a business needs a bank loan, the bank is going to demand audited statements. Merging with another company, the valuation completely relies on audited numbers. They can even be used in a court of law to settle disputes. It truly is the anchor of trust in the modern corporate world.
So, having traced auditing all the way from ancient ledgers and Chanakya's keen observations straight through to the complex corporate trust systems of today, I want to leave you with a thought. How will you apply these foundational concepts to safeguard integrity in your own future career? Keep that question in the back of your mind as you prep for your exams.
Today, we're taking the nature and essential features of auditing, and we're turning them into a rock-solid, incredibly easy-to-remember study guide. We're definitely not just going to sit here and read a textbook together. Nope, we're building a mental framework you can walk right into that exam room with.
Here is the roadmap for this explainer. First, the paradigm shift. Second, the modern definition. Third, the 6 essential features. And finally, the core philosophy. Let's get right into it.
So, let's kick things off by busting a pretty massive myth. Is auditing just mechanically checking math and ticking off ledger entries? If your brain immediately went yes, or even kind of hesitated with a maybe, well, I'm glad you're here, because the modern auditor, they are way more than just a passive human calculator. Understanding why is absolutely foundational for your exam.
Section 1, the paradigm shift.
All right, let's talk evolution. Traditionally, major bodies like the IASB and experts like Mouts defined auditing pretty strictly. It was entirely about verifying accounting data and financial records, just crunching numbers and reporting on whether the financial statements were reliable. But over the last few decades, wow, the scope has exploded. Today, an audit could mean reviewing a company's compliance with laws, digging into their costing records, or even evaluating their daily operations and how well management is actually performing. It is literally a paradigm shift. It is so much more than just checking the math.
Section 2, the modern definition.
Okay, I want you to lock the ICAI definition into your memory right now. The Institute of Chartered Accountants of India defines auditing as a systematic and independent examination of data, statements, records, operations, and performances. And here's the kicker: financial or otherwise. That little phrase right there, financial or otherwise, that is your gold-plated proof that an auditor's playground is massive now. It officially recognizes that you can absolutely audit things like managerial performance and cost data, not just the balance sheet.
Now, if we want to put this massive modern scope into a practical framework, industry experts Ahrens, Elder, and Beasley hit the nail on the head. They say auditing is the accumulation and evaluation of evidence about information. Why? Well, to determine and report on how well that information actually matches up with established criteria. And crucially, it has to be done by a competent, independent person. It sounds a little dense, sure, but it's actually a brilliant, perfectly logical formula for the day-to-day reality of the job.
Breaking that down gives us 3 absolutely non-negotiable rules. Perfect takeaways for your exam, by the way. First up, the information you're auditing doesn't have to be accounting data, but it absolutely must be verifiable. You have to be able to prove it. Second, you can't just go off your gut feeling. There have to be established criteria or systematic standards to evaluate against. And third, you, the auditor, must be technically competent and maintain a completely 100% independent mental attitude. Objectivity is literally everything.
So how do you evaluate information objectively? You rely on audit evidence. This is a massive concept for your exams. Evidence is the backbone of any transaction review, and you'll generally see 2 main types. You've got internal evidence, stuff generated inside the company, like records, vouchers, and books of account. Then you've got external evidence, which is basically the holy grail because it comes from the outside. Think bank balance confirmations or even bringing in an independent expert to weigh in on something highly technical. You simply cannot do an audit without gathering and obsessing over this evidence.
Section 3, the 6 essential features.
All right, let's break down the first 3 of these 6 essential features. Think of them as the groundwork. Feature 1, auditing involves evaluating and verifying the relevance, reliability, and adequacy of evidence. Yep, those vouchers and documents we just talked about.
Feature 2, once you have that evidence, you do an analytical, critical, and investigative review of the accounting systems and internal controls. Feature 3, always remember, the information you're looking at can be financial or non-financial. See the story we're building? It's not a random list to memorize, it's the actual step-by-step reality of what you'll be doing.
Building right on that groundwork, Feature 4 says there must be systematic, scientific standards for your evaluation. Feature 5 is all about you. The auditor must be competent, fiercely independent, legally qualified, and hold a certificate of practice. And Feature 6, this is the grand finale. The whole point of the audit is to ensure the reliability of information so you can form an authentic opinion on a true and fair view of the business's state of affairs and its profit or loss. Every single audit essentially funnels down to this exact outcome.
I really want you to lock this term into your memory, true and fair view. Knowing this is crucial because ensuring a true and fair view is the ultimate endgame of any audit you will ever conduct. It's the goal that lets you form a genuinely authentic opinion on an enterprise's financial statements. And here is a highly testable detail. This applies whether the enterprise is trying to make a profit or not, and whether the audit is legally required or totally voluntary. The endgame never changes. It's always about finding that true and fair view.
Section 4. The core philosophy.
Let's finally and completely squash this idea of the auditor as a passive calculator. Auditing is absolutely not a mechanical comparison of financial statements against entries in the books, and it's sure as heck not just mindlessly ticking off entries against vouchers. If you're just sitting there matching numbers and ticking boxes without actually critically thinking about what those numbers mean in the real world, you're not auditing.
Which brings us to the true investigative soul of this profession. The source material frames this perfectly. It says, auditing is a process of collection and critical evaluation of evidence. It is analytical, it is critical, investigative. Thus, auditing has its principal roots not in accounting, which it reviews, but in logic, on which it leans heavily for ideas and methods. I really want you to let that sink in. Your principal root as an auditor isn't accounting, it's logic. You use logic to review the accounting.
So I want to leave you with a thought as we wrap up this explainer. If the very soul of auditing is rooted so deeply in logic and investigation, how are you going to apply that critical mindset to absolutely crush your next CMA exam question? Don't just mechanically memorize the rules. Understand the logic behind them. Lean heavily on that logic. Keep that investigative spirit alive in your studies. So whether you're just starting to build out your foundation of financial knowledge, or maybe you're just looking for that final structured review right before test day, you are definitely in the right place. All right, let's dive right into this.
So there's this really bold, overarching premise straight out of your study materials. It says auditing is the critical aspect of accounting. Just think about that for a second, right? Without auditing, accounting is basically just an organization's unchecked version of its own financial story. Auditing steps in to act as the ultimate check on management and the accountants themselves. It's the critical mechanism that aims to detect material misstatements and frauds, essentially making sure that the financial story being told is actually rooted in reality.
Okay, here is our roadmap for the explainer today. 1. Core objectives. 2. Accounting, building the books. 3. Auditing, the postmortem. 4. Key differences in the process. 5. Key differences in roles and rules. And finally, 6. The final exam takeaways.
Section 1. Core objectives and building the books.
Well, accounting is fundamentally all about building the books. Its basic objective is to record every single economic event that changes the financial position of an entity. Accountants are out there collecting, classifying, and summarizing data so they can prepare statements of performance and affairs for each accounting period. They're actually measuring business events in monetary terms right at the time they occur. So you can think of the accountant as the builder of a financial foundation. They're laying down the bricks exactly as the transactions happen.
Section 2. Auditing, the postmortem.
Now, the auditor's mission? It's pretty clear-cut. Auditing is undertaken specifically to appraise the authenticity and reliability of those accounting records we literally just talked about. And the ultimate goal here is to form a conclusive opinion on whether the financial statements exhibit a true and fair view of the organization's financial performance and state of affairs. For your exam, please lock in these buzzwords: authenticity, reliability, and true and fair view. Auditing is this analytical, highly critical examination designed to detect material misstatements and frauds.
So, we know one builds and the other inspects. Simple enough.
But from an exam perspective, what are the specific, testable differences between these two disciplines? How do we clearly separate them when we're writing out our answers? Let's break it down.
Section 3. Key differences. The process. Just notice the stark contrast in timing here. Accounting is highly real-time, right? It's the recording of transactions exactly at the time of occurrence. Auditing, on the flip side, is strictly a post-mortem analysis. The transactions have already happened, the books are completely closed for the period, and now the auditor is coming in after the fact to examine what was recorded. I mean, you literally cannot audit a transaction that hasn't even been accounted for yet.
And that leads us right into the actual nature of the work itself. An accountant measures the business events in monetary terms, records them, and then communicates those results. They compile the data and hand over the financial statements. But here's the kicker. They aren't expected to independently review or report on their own compilation's authenticity. That's where the auditor steps in. They analytically and critically examine those very books and records, specifically to form and submit a report with their opinion on those true and fair assertions.
Section 4. Key differences, roles, and rules. All right, pay super close attention here, because this brilliantly illustrates a classic exam trap. Who exactly do these professionals work for? Well, an accountant works directly for the management. Their primary responsibility is to the management, making sure financial statements can actually be prepared from the records. But an auditor? An auditor is an independent person appointed by the business entity, and they are accountable to the owners or the shareholders, not the management. That independence is quite literally the bedrock of the entire auditing profession.
Building right off that accountability is the concept of liability. In accounting, there's generally no third-party liability. If an accountant makes an error in their compilation, well, their issue is strictly with management. However, because external parties actually rely on an audited financial statement to make massive investment or credit decisions, an auditor could realistically be held liable to third parties in certain circumstances. This is a highly specific, very important professional distinction that pops up on CMA exams all the time, so absolutely make sure you jot it down.
Next up, let's talk statutory requirements. Maintenance of accounts might not be mandatory for small individuals or partnership firms under Section 44AA of the Income Tax Act, though it is 100% mandatory for companies under the Companies Act. Auditing has a slightly different threshold. An audit could actually be exempt for various small partnerships under Section 44AB of the Income Tax Act, and that's even in cases where maintaining the books of accounts is a statutory requirement. Though, of course, just like accounting, auditing is strictly mandatory for companies under the Companies Act.
And to wrap up these rapid-fire comparisons, we've got the governing principles. Accounting is done according to the principles set by Indian Accounting Standards, or IND-AS. Auditing, however, follows its completely own rulebook, governed by the Standards on Auditing. It just makes sense, right? Two very different jobs require two very different sets of guidelines.
Section 5. Final Exam Takeaways.
This summary table is basically your ultimate cheat sheet. I highly suggest you take a mental photograph of it right now for exam day. It perfectly maps out all 7 of the primary differences we just discussed right side by side, from the collection and summarization of accounting versus the analytical and critical examination of auditing, right on down to the liability and statutory requirements. Whenever you are asked to differentiate the two, let this table be the absolute framework for your answer.
And if you want to completely maximize your points, here are the essential exam buzzwords that you absolutely must use in your written answers. Trust me, examiners are actively scanning your paper for these exact phrases. Contrast accounting's real-time recording with auditing's post-mortem examination. Always mention that the auditor is an independent person looking for material misstatements to ensure the financial statements present a true and fair view regarding their authenticity and reliability. Hitting this specific vocabulary demonstrates absolute mastery of the material.
So, I want to leave you with a final, somewhat provocative thought to wrap up today's explainer. If accounting meticulously builds the financial reality, and auditing provides the ultimate independent check on that reality, who truly holds the power over an organization's financial truth? Is it the creators of the data or the independent watchdogs who verify it? Understanding that dynamic tension is really the key to mastering financial management. Keep that in mind as you continue your studies. Look, if you're a CMA Intermediate student getting ready for your upcoming papers, you already know the whole auditing versus investigation topic is high-yield territory. So today, we're cutting straight through the jargon. We're going to break down the core differences, and we'll map out the exact scope of SA 200 so you can walk into that exam room with absolute confidence. Let's get right into it.
To kick things off, we really need to ask ourselves a fundamental question about our mindset when we walk into a business to examine their books. Are we acting as a routine watchdog, just looking for the truth? Or are we a suspicious bloodhound hunting for a specific fault? That analogy right there perfectly captures the shift in perspective between an auditor and an investigator. Honestly, keeping this watchdog versus bloodhound idea in the back of your mind is going to make memorizing all the technical differences so much easier.
Here is our roadmap for this explainer. 1. 2 fact-finding missions. 2. Audit versus investigation. 3. The 7 key differences. 4. The scope of auditing. And 5. SA 200 core objectives.
Section 1. 2 fact-finding missions.
Okay, so first things first. Both auditing and investigation are at their very core fact-finding missions, right? They don't just take management's word for it. Both fields require a highly systematic and critical examination of the available evidence. Whether you're the auditor or the investigator, you are absolutely digging deep into the data. But, as we'll see, their starting points and their ultimate destinations are vastly different.
Section 2. Audit versus investigation.
Let's talk about the audit. This is our watchdog. The exact textbook definition you want to remember is that auditing is an independent and systematic examination of the evidence underlying the accounting data. And what's the ultimate goal here? It's simply to ascertain a true and fair view of the financial statements of an enterprise. It's basically a routine checkup just to make sure everything is being presented honestly and according to accepted practices.
An investigation, however, is our bloodhound. It's defined as an examination of accounts and records with a view to ascertain any fact for some special purpose. Now, that phrase, special purpose, is your golden key for the exam. An investigation isn't a routine checkup at all. It varies wildly from assignment to assignment, heavily depending on what specifically needs to be uncovered. You know, like investigating on behalf of an incoming business partner or maybe looking into a suspected fraud.
Section 3. The 7 key differences.
Let's start contrasting these two, beginning with scope and objective. Auditing naturally has a wide scope, and in a statutory audit, that scope is specifically determined by the relevant law. The objective is incredibly broad, to verify truth and fairness across the entire board. Investigation, on the flip side, has a heavily limited scope. It's usually restricted to very specific periods or just certain areas of the business, purely because its objective is driven entirely by that special purpose we just talked about. Now lean in and pay close attention here, because these are major exam keywords. When it comes to evidence and approach, an auditor evaluates records based predominantly on persuasive evidence, and their mindset is one of professional skepticism. Skeptical, but not suspicious. An investigator, they start with suspicion. They assume something might be wrong right out of the gate, and they collect evidence to either confirm or dispel that suspicion. Because of this, an investigator draws conclusions only on the basis of substantial or even conclusive evidence. Persuasive versus conclusive, skeptical versus suspicious. Seriously, burn those words into your brain for exam day. Moving on to procedure and periodicity. Audits are routine annual exercises, and they strictly follow generally accepted auditing principles. Investigations are just a completely different beast. They involve what's called an extended auditing procedure, diving much deeper than a normal audit ever would. And because they dive so deep, they aren't neatly tied to a financial year. A really complex investigation might drag on for well over a year.
So if you're building out your study notes, this is basically your master cheat sheet. You need to know these 7 parameters inside and out, meaning scope, objective, audit procedure, evidence, approach, and periodicity. If you can recreate a comparison using these exact 7 bases on your exam, you are going to be golden. It neatly organizes everything we've just discussed into a perfect, easy-to-grade format.
Section 4. The scope of auditing.
To really grasp the modern scope of auditing, we have to look backward for just a second. Historically, back in the ancient period, auditing was really limited. It was mostly just checking basic receipts and payments. But as you know, the business world grew incredibly complex over time, and the scope of audit extended right along with it. Today, in the modern era, the scope of a financial statement audit is strictly determined by 3 key things: the terms of the engagement, the requirements of relevant legislation, and the official pronouncements of the Institute of Chartered Accountants of India, or the ICAI.
And here is a huge trap to avoid on your exam. Even if something isn't explicitly mentioned in the terms of engagement, an auditor absolutely cannot leave any relevant aspect of the organization unchecked. Plus, a client can never use the terms of engagement to try and limit the auditor's scope regarding matters that are prescribed by law or by the ICAI. The auditor is always, ultimately, responsible for a comprehensive review.
Section 5. SA200 Core Objectives.
SA200 actually breaks down the auditor's required scope into 3 core pillars. Whenever you think of SA200, I want you to think of these 3 steps. First, assessing the reliability and sufficiency of information. Second, determining the proper disclosure in the financial statements. And third, exercising professional judgment on material items. Let's quickly unpack each one of these to see how they actually work in practice.
For that first pillar, assessing information reliability, the auditor obviously doesn't just guess. They have to use appropriate audit procedures. Now, SA200 categorizes these into 2 distinct types. First, we have compliance procedures. This is where the auditor studies the accounting system and checks if the internal controls are actually working like they're supposed to. Second, we have substantive procedures. This is the heavy lifting, where the auditor tests the actual authenticity, accuracy, and completeness of the information sitting in those accounting records.
Moving to the second pillar, determining proper disclosure. Here, the auditor's job is to ensure that the final financial statements aren't just mathematically accurate, but that they tell the right legal story. They must ensure everything is disclosed properly, strictly conforming to the applicable generally accepted accounting principles, your GAAP, and the statutory laws, like the specific requirements laid out in the Companies Act. You'll definitely want to drop those specific terms into your exam answers.
And finally, for the third pillar, the auditor has to exercise some really sharp professional judgment. Let's be real. An auditor cannot realistically check every single penny in a massive corporation. Therefore, they have to focus their energy primarily on items that are material, meaning items that, either individually or as a group, are significant enough to actually impact the organization's overall financial picture and ultimately influence the decisions of the people reading those statements.
Ultimately, the days of an auditor simply acting as a human calculator are long gone. A modern auditor does way more than just mechanically tick off accounting entries based on some available vouchers. They are fully required to deeply evaluate the true authenticity of the business's transactions, ensuring they are appropriately recorded and fully comply with all the prevalent statutes.
So, as you wrap up your prep, keep our opening analogy front and center. When you read a tricky scenario question on exam day, stop and ask yourself, is this a situation requiring the routine, persuasive skepticism of an auditing watchdog, or does it demand the targeted, conclusive suspicion of an investigative bloodhound? But beyond the exam, think about this. As businesses rely more and more on AI and insanely complex global networks, is the line between the routine watchdog and the suspicious bloodhound going to start blurring? Mastering these foundations today is really just the beginning of understanding the future of financial forensics. Thanks for tuning into this explainer. Good luck with your studies and stay curious.